Well, how's it going, friends and family? My name is Amos, and I hope your day's going well. And if not, maybe you can take your mind off of things as we talk about the stocks reporting their earnings this week. If you can't tell by the tone of my voice, bro, this is going to be laid back, chill. And you might as well treat it like a podcast on your commute to work, okay? What I'm about to say next, I do not say lightly. It's going to be a huge week in the stock market. I mean, just take a look at your screen right now. Only for like the next 20 seconds or whatever. Take a look at some of the heavy hitters that are reporting their earnings. And I'm not just saying that for attention or clickbait. Dude, this is a huge week. By the way, what do I mean by earnings? Because I'm cognizant that not everyone is aware of what it is. When it comes to a publicly traded company, they have a fiduciary responsibility to let the investors know what the heck is going on every 90 days. So you get a sit rep, which is a situation report on how their operations are doing, their financials, and if there's any upcoming headwinds. And as an investor in the stock market, I think everybody can benefit from staying up to date, especially if a stock's on your watch list, or more importantly, if it's in your portfolio, right? You'd want to know what's happening. Should I feel bullish? Should I feel bearish? With that said, on a high level, these are my call outs, and then we'll go into each day of the week in depth. I would say the Mag 7, we got Apple, Microsoft, Meta, and Tesla. 3 of those Wednesday after the markets close. It's going to be big. What I'm saying is if any one of these 3 reports anything negative, they're going to pull down the entire S&P 500 down with them into the red for Thursday. I'm calling it. That's not financial advice, but I'm just saying it for entertainment purposes because the Mag 7 props up, I would argue like 40, maybe 50% of the sentiment in the stock market because they're doing so much of the AI-related data center spending. So case in point, if they're saying, hey, things are not looking too good, the ROI on the capex is not looking good, dude, every single company that supports them directly or indirectly, the semiconductor chips, the beneficiary players that use their data, everybody's going to get punished equally. And in the case of what do I mean by negative? See, one thing that kind of chaps my nipples is Wall Street is so short-sighted. They only care about profits in the immediate 90 days, right? Like what we're talking about. But, you know, as a guy that follows Peter Lynch, Warren Buffett, and investing for the long run, it boggles my mind. They get so worked up over companies saying, hey, we need to put down some capex right now to set the foundation so we can increase our bandwidth going forward. Dude, Wall Street hates that. So negative is if Apple or Microsoft, Meta or Tesla says, hey, we're going to have to increase our capex more than anticipated previously, the market's going to punish them harshly. Now, out of those 4, I would argue Microsoft is probably the most undervalued. I mean, Meta's right there with Microsoft, but Microsoft, even right now, if you jump in, I can't blame you. Me personally, I'm holding out. $400 or less is my price target, but if the market overreacts and they punish them down to like $395, $380, I'm jumping back in. Okay. What else do we have? We also have the physical infrastructure that's supporting the AI movement. What I mean by that is we have ASML. They sell the equipment that makes the semiconductor chips. We also have Texas Instruments. We also have Lam Research. Dude, when I made a deep dive video about Lam Research last year, I almost pulled the trigger. Almost. But I didn't. I know. Hindsight is 2020. And at the time, I think I put my money into Oshkosh Corporation instead. And the ROI on that was like 80 or 90%. Pretty happy about that, right? Don't get me wrong. But with Lam Research, I think, let me look it up. What is their LCRX? What is their 1-year total return? 188%. So I guess it's me kicking myself in the head of like, Yeah, the 80% ROI was nice with Oshkosh Corporation, which, by the way, they make vehicles for the United States military. But 188% sounds a lot better, doesn't it? But anyways, I think ASML and Lam Research, they're just way too pricey right now. But who else do we have? I guess in the same conversation, right? The military stocks are reporting. Dude, I'm so freaking excited because, I mean, as we learned last time, Lockheed Martin said, hey, we had some setbacks in our classified secret projects and the market punished them harshly, right? And then what happened the next 2 months? Lockheed rebounded and then reached all new time highs, right? So case in point, if anything happens to RTX, Northrop Grumman, where's another military player here? Or Lockheed Martin right there, I'm jumping in. The only one where I do not care at all is Boeing. Honestly, you have to pay me to invest into Boeing. I just don't believe in them. I don't like their financials. And out of the entire military stocks landscape, to be honest with you, that's the one I feel the most bearish about. But who else do we have? We have Visa, we have MasterCard, and American Express. I told you, this is a heavy week. Some of you think Visa and MasterCard are undervalued right now. The other day, I want to say like last week, I actually did an intrinsic valuation for all three of these companies, and none of them are undervalued. I really wanted to believe that Visa was undervalued because they're sitting at pretty much flat for the past 1 year, but they're not. They're not undervalued. They're actually fairly valued across the board for these three. But I think it would be good to tune in to how things are going because, again, it kind of gives you a understanding of how the consumers are doing. Because for each one of these companies, well, these two in particular, and this one lesser so because it's more of like a credit or a cashback card. But anyways, if spending is business as usual or not, like that's the big question that's going to be answered from these three companies. But I will say this, if Visa does drop down because something catastrophic happened, I mean, it really depends. Like if they're going to admit scandal and fraud, maybe not so much, but I'm talking about what's a setback where I'm willing to turn a blind eye towards? Like if they miss, for instance, right, like the guidance for their revenue, I don't know, we'll take a closer look here in a little bit. Like if it's like $20 billion and they hit like $19.9 billion and the market punishes them to the point where they drop like 10%, maybe I'll jump in. Because to me, I feel like that's not enough to warrant a company to be punished 10%. Well, in the context of a dividend compounder with cheese. Obviously, with a shaky-ass startup that may or may not be profitable, 10% is a little too nice. I feel like they should be punished like 30, 40%. But for Visa to be punished that harshly, I would jump in. And then also on a high level, we have Starbucks. Dude, I used to be investing into Starbucks, and after like a small profit, I want to say like 15% ROI, I jumped ship. I just don't believe in them anymore. I don't think they have an economic moat anymore. And the beverage industry is cutthroat. Everybody's launching their own coffee menu, right? Like ranging from McDonald's to the Chinese players. They're coming here and opening up shop in the US, in particular, Luckin Coffee. I'm fearful about Starbucks' future. If you're invested into them, I'm sorry. I mean, I could be wrong, but it is what it is, right? There's also United Health. I'll be honest with you. I think United Health makes up like 24. I guess it's just safe to say about a quarter of my portfolio's holdings. So much of my capital is into United Health. I'll be honest with you. If things are not good this quarter, I'll be really upset. But I'm still going to hold on because depending on how the situation changes, I do have their fair value estimate at about 600 to 650 in roughly 3 years from now. They're currently like, 340, 350. So I'm holding on, but if this earnings report, they disclose that their CEO is a hot mess and he's a racist and they're running into accounting fraud, to be honest with you, I might jump ship. I mean, I'm in the green right now by like I think it's like 31%. And obviously, I would like to hold for the long term. But if they do something stupid like that, dude, I'm out, right? Because when you invest into a company, you need to have an investing thesis. And when they operate in a way that's counterintuitive to what you believe in that company to be, then I would argue that's a valid reason to jump ship. But if you're jumping ship because of like short-term noise or the day-to-day sell-offs, then I don't think your investing thesis is strong enough. Just throwing that out there. And then there's also the telecom giants, and I'm going to expand upon my opinion once we get to that point. So Verizon and AT&T, and hopefully I can remember myself because I used to kind of dismiss them, but I'm coming around. Now, having said that, rest of the video, let's jump into each day of the week in detail. And here we are in the earnings calendar, starting things off on a Monday. Who do we got? We got Nucor, the steel manufacturer. We got Ryanair. Ryanair is basically, from my understanding, the Spirit or Frontier Airlines of Europe, the budget one. There's Brown & Brown. We just covered them on the channel, an insurance broker. Actually, wonder how they're doing since we covered them. Let's see. Oh yeah, they're pretty much flat from exactly when we covered them on the channel. Yeah, that's to be expected. I talked about that in the video, how they're fairly valued right now, so they'll probably trade sideways up until their earnings, and then that's when the drastic change in their stock price will happen, either up or down massively, either direction. By the way, I don't know if you're in the know or not, but I'm a first-time dad. Dude, my baby girl, she just turned 100 days old, and in Korean tradition, it's a pretty big one, because obviously in the past, newborns and infants, they didn't really live long, and the survivability rate was pretty low, right? Considering South Korea used to be one of the more poorest countries in the world. I think they were in the bottom 10 GDP, which is kind of crazy to see their comeback and bounce back. But anyways, she just turned 100 days old. And I'll be honest with you, fatherhood has been pretty amazing. I mean, just the shift in my mentality. And because previously, I used to be a little more selfish in terms of what about my needs? What about my wants? What if I need to go poop right now? But I'm finding myself serving her, right? I'm a grown-ass man, and I'm serving a baby. So it's a really different dynamic that's also very humbling at the same time. And now there's somebody who I prioritize ahead of myself, which is, I think, a good thing for a man to develop, right? Because if you always live your life with the sense that you're the most important thing in the world, or in the tendency of a narcissistic, I don't think that's healthy, right? I think to put others above you, I think that's a noble thing, to prioritize and to take care of those that are around you. I think that's one of the final forms of becoming a man. And it doesn't have to be a kid or spouse. It could also be your community and your workplace and the relationships that are around you, personal or professional. I think once you start taking care of those that are around you, that's when you understand I'm truly a man now. I think you're still a boy and you operate with an immature mindset when you only think about yourself. But anyways, that was a stupid rant. Sorry, guys. Monday, who do we got? We got Graco, Crane. Oh my gosh. So this one right here used to be on my radar for half a second. Alexandria Real Estate. It's basically a REIT that owns an inventory of buildings that is geared towards life sciences, pharmaceutical, and biotech companies. But with the current party in power, they've been cutting the funds for research, for medical studies and everything. So they've actually been not renewing their leases, okay? So Alexandria REIT's been suffering, and they went on a pretty big sell-off once they disclosed the stuff that I just told you, but they also insinuated at the fact that they're going to have to cut their dividend in 2026 by up to 50%. Now, I don't know if they executed on that promise or not, but yeah, it's a REIT that I just don't have any interest in going towards. Okay, there's so many other high-quality REITs. Alexandria is the definition of a cigar butt company, because as of right now, they're screwed. absolutely screwed, because if you're in the business of renting out building space for companies and those companies are struggling because they're running out of funding from the government, I would argue that's a hot mess. And it's going to be reflected in their dividends, right? Because for a REIT, they're legally bound and obligated to pay out at least 90% of their profits as dividends. But if those profits are shrinking, why would you want to invest into a sinking boat, right? There's so many other high quality companies that are being sold off and are undervalued that aren't necessarily sinking. But for Alexandria REIT, nah, dude. But that's my personal opinion. Obviously, it's an S&P 500 company, so I think in the future they'll be okay. But that's definitely one of those things where if you buy into, you're going to have to wait 5 to 10 years to see a pretty good ROI. I'm not trying to say that I'm not patient enough to do it, but my whole thing is if there's way better options out here, it's not like someone's holding a hammer to my left nut and they're like, dude, you better invest into it or I'll smash it. No, I have freedom of choice and I just don't want to invest into it, okay? I don't know why I got so defensive there. I'm a weird dude. Anyways, there's a lot of regional banks that are reporting, and then I don't really like to look at companies with a market cap below of like 500 million, because then it's just way too volatile for my taste. I like to invest into mid cap or large cap. They're more established and more, I guess, the float makes more sense to me. Whereas with small caps, you'll see fluctuations in their stock price that will literally make your stomach turn, and it's just not my cup of tea. But anyways, on Tuesday, we have United Health. Obviously, talked about it in the introduction. I'm feeling pretty confident about it. I think they're going to do okay. What's the expectation? Sorry, let me just click back right here. By the way, did you guys know that I turned my mouse purple so that you guys can see visually where my eyes are looking? Hopefully that helps out. And if you're just listening to this as a podcast, as you're sitting on the toilet, then I guess you don't know what I'm talking about. But anyways, see the expectations for United Health right now, the bottom line, the profitability, it's supposed to go down by 69% year over year. Revenue up by 12.6%. I think if they report less than desirable results, I'm not going to say that I have a genie in a bottle, but I think it's going to be priced in. I think what the market is more so sensitive about is guidance about, I suppose, because right now, United Health, they're caught in a lot of markets of offering health insurance services where it's not good margins, right? And I think they want to know whether or not United Health's going to exit those markets, or if they're going to double down and stay committed to losing money to service it. And I think, me personally as an investor, I would like to see them stay committed, but if they cut ties, I would understand from a business lens. But from a personal and morality lens, I would hope people don't lose their health insurance coverage. But anyways, taking a look at their top line, 12% year over year, I think they'll be able to pull it off, right? I mean, if you take a look at the trend past to previous quarters, the revenue went up by 12%. I think the revenue situation should be business as usual. I'm not bearish about that, but I'm more concerned about, as you can see, like their bottom line expectation is supposed to go down by 70%. So I think the market wants to know, is this going to continue? Is this trend going to improve? To be honest with you, I don't know. And that's why I need to tune in as well, okay? There's RTX. I would like to buy into them, but dude, I'm going to be completely honest. They're so overvalued right now. Golly, that's why I love the military stocks, okay? I just uploaded a video talking about my best stock picks for 2026. And I mean it when I said I think the military stocks are going to outperform the S&P 500 in 2026. And I'm putting my money where my mouth is, and I'm personally investing into military stocks, so we'll just see how things go. And if RTX goes on a pullback, sell-off, I'm jumping in, okay? I don't even want to talk about Boeing, okay? Low quality, but it's essential to the U.S. that they don't fail. And one thing that I learned alongside with Intel is that when a company is important for, or I guess to protect the interests of the U.S. is never going to let them bail. They're going to bail them out. Just like the big banks like JP Morgan Chase, Boeing, Intel, So with Boeing, like even though I personally think they're low quality, let's let their numbers do the talking. If you invest into them, I can't blame you. Me personally, I don't like seeing this, where their revenue is fluctuating up and down, it's inconsistent. I don't like that. And they're also a dividend cutter, right? How do I know this? I used to be invested into them in 2019. And then one day they decided to cut the dividend and I sold out of them. I was like, okay, I'm out, because my investing thesis changed. I was like, no, they're no longer a dividend growing compounder. If you cut the dividend, that changes the whole thesis, right? So maybe that's why I have salty feelings about them, but needless to say, Boeing's going to be protected and they're going to be bailed out by the US time and time again, just like Intel. So if you invest into them, I can't blame you. I honestly understand why. Because there's basically two big major players outside of, I guess, the context of China. But in the Western world, two companies. There's Airbus and Boeing that make commercial flyers. Now, if Boeing fails, then the French company Airbus is the only one that's going to be manufacturing planes for United Airlines, Alaska Airlines, Delta, and we're never going to let that happen, right? We're going to protect the interests of the U.S., and Boeing's important. Too big to fail. Sucks that I even have to say that, but it's truly a thing. There's Next Era Energy. My personal opinion, I think it's probably pound for pound the highest quality utility stock. Yes, I said what I said. I think it's the best. But right now, I think they're overvalued, to be honest with you. But if you're invested into them, I'm happy for you because they're doing pretty good. Well, if you bought into them 5 years ago, not so good. But I think most people that invested into Next Era, you probably invested into them in 2024, 2023 when they went on that sell-off. So if you only consider the past 2 years, you're in the green by a significant amount. And it's a utility. It's not going to disappear, and it's a regulated monopoly. It's a really good business operation. Texas Instruments, Union Pacific. Speaking of which, reading a book about the Native American history, and even in the 1800s, Union Pacific was laying down railroad tracks across Colorado, Nevada, California, with the free labor, right? Or I guess not the free. They paid Chinese migrants to do it at less than minimum wage. Just the fun facts, right? I used to be invested into Norfolk Southern, which is one of the biggest competitors to Union Pacific. And me personally, I sold out of the railroad industry entirely. With Norfolk Southern, I sold out with a 60% gain. And I don't regret it. Because when you take a look at the railroad's performance, I mean, obviously this is only one player, but he's the biggest one, I think, in terms of market capitalization. Their performance is not that good, and it tends to be cyclical. There's highs and lows baked in to the point where you're not really getting an outperformance in the market, and that was one of my driving reasons to jump ship. Because when I had my investing thesis at first, I was like, okay, it's a regulated monopoly, and a lot of our stones and commodities and lumber, it's transported not through trucks, not through planes, but through the railroads, right? Including oil and gas and stuff like that as well. So I was like, okay, it's a business that's here to stay and should thrive. But that's where I was wrong. They don't thrive. They just do enough to get by. And their financials, as you can see, it's nothing to write home about. It fluctuates, it's volatile, and it's pretty much flat after 10 years. Well, it's not really. It went up 21 billion to 24 billion, but it's not moving the needle much. And in the past 2 years, Union Pacific, the revenue up 0.5%, 1%. So with the railroads, it's an industry that I just don't think is worth it. I just, my whole worldview about logistics have changed. I mean, this might be unpopular, but I truly think if you want exposure to logistics, don't think about the railroads or UPS and FedEx. Think about it more so in the future lens. Think about who's conquering the supply chain battle right now. I would argue it's Walmart, and I would argue it's Amazon. And then also thinking a little bit ahead of that, who are the ones that are going to be conquering the last mile delivery? Drones that are being developed for that purpose, right? I would think more of that rather than railroads, trucking, and UPS, FedEx. It's just my opinion. I could be wrong, but it's just what I think. Anyways, we got Northrop Grumman, parent company of the bombers, the stealth bombers. Dude, I was watching a YouTube video the other day like a flight demonstration. I was like, dude, it would be so sick to be the officer that gets selected to fly one of their planes. Because there's only like, I don't know if it's the B-2 or B-21. There's only like 15 in operation. 15 planes, that's it. And to be selected to fly one of those instead of one of the F-35s or F-15s, dude, that would be sick. I guess a regretful story to share is when I was in the Army, I actually had the opportunity to become an aviator, a pilot. I don't know what aircraft because I never went down the pipeline, but I gave up that slot. I could have been a pilot, passed through all of the checks, the medical, everything, eyesight, good to go. But back then, I think this was like 2011, 2012, the service obligation to go through flight school and to do all of the bells and whistles, it was so long. And I was like, dude, I don't know if I want to be a pilot in the Army for like, what was it, like 10, 12 years? So I decided not to do it. Ended up becoming an infantry officer, and the rest is history. But I always think about what if? What if I took the opportunity to be a pilot, right? Because I know a lot of people would do whatever it takes to become a pilot, and I had the opportunity, and I said no. I just, I don't know. I guess that's one of those things where you reflect on once you become a little older. I'm 35, and you start thinking, like, did I make the right choices in life, right? And it's like, I don't know. But anyways, there's UPS, there's Seagate. I don't really like Seagate, okay? I think some people feel bullish about them. I think their business operation, it's about storage in HDDs, hard disk drives. Oh yeah, as depicted right there in SSDs. I think the better play here is probably Micron, because with Seagate, they primarily were known for their hard disk drives. And I think they just recently made that pivot into the SSDs. So all that to say, with Micron, from the get-go, they've always been about the SSDs, right? So I don't know. And plus, at this valuation, at their all-time high in the past 5 years, I mean, look at this. I feel like it's too late to jump in anyways, right? So it is what it is. I do think it's high quality, but I don't think they're the best one. Best one is Micron. I'll stand by that. There's PACCAR. They make diesel engines for the trucking industry, which, as you know, America is run by the truckers. But I'm not particularly bullish about them. And then there's Roper Technologies. I went over them in the software industry breakdown video. There was a part 1 and part 2. And I talked about how this one, it's on my radar. And I'm actually going to be tuning in because I do want to buy in. I just don't know if this is a good price point right now, right? Because they're falling off a cliff. And as the old saying goes, why catch a falling knife, right? So I don't know how things are going to go for their earnings. But what I do know is if they go on an emotional sell-off, meaning the tangible objective data wasn't so bad, but the market overreacts, I might jump in. So Roper Technology, they make software for the underutilized, what's the right word here? Unsexy industries. So when I think about the truckers, when I think about the water utility companies, educational systems, they make software for them. The investing thesis is pretty simple. I like them because a lot of industries depend on them because nobody else wants to make software for them, right? So I like them, but they're in some heat right now because obviously they're a software company. And people are insinuating that AI is going to make software obsolete. So when you want to Google Intuit, Adobe, the list goes on and on, all those stocks, dude, they're being punished as if they're going bankrupt. So I guess we'll find out in 3 to 5 years. Was hedge funds and Wall Street correct, or were the amateur investors correct? Because based on my understanding, I think a lot of the amateur investors piling their money into Adobe, Salesforce, and everything, but big money, they're scared. So we'll see who's right. There's Kimberly-Clark. I covered them in a previous video, I think like a month ago, because they went on record by saying that they were going to buy out and acquire Kenvue, which I would argue the better play is Kenvue, so that once they get bought out, because I did the math and I showed it on the screen, by buying into Kenvue at my memory's a little fuzzy here, but at XYZ price, you walk away with like a 20 or 25% ROI for holding onto Kenvue for like, a year, whenever the transaction closes. But with Kimberly-Clark itself, I probably wouldn't want to buy into them. it's not that maybe I'm being a little too harsh here. Maybe it's because ask yourself this question. Are you bullish about the paper industry? Kimberly-Clark makes bath tissue. They make feminine products for that time of the month. And diapers. Look, I have a newborn and we're doing the whole cloth diapering thing. I just don't feel particularly bullish about Kimberly. But with Kenvue, I don't really feel bullish about them either, but it's a matter of getting a 25% ROI for holding on to them for less than a year. No, I'm not invested into Kenvue, but yeah. Anyways, moving on. Packaging Corporation of America, that's an indirect play on Amazon based on their e-commerce industry, because think about it, right? If they provide the cardboard packaging paper, the demand increases as Amazon ships more stuff, correct? So Logitech. I'm trying to see if there's anything that's Manhattan, American Airlines. Dude, I don't like the airline stocks. I know some people swear by them. I just think it's just way too cyclical. You see what I'm saying? There's highs and lows, highs and lows. Because the thing is, like, I don't know if I'm being too picky here, but when it comes to, like, trying to acquire and accumulate dividend compounders with cheese, I want a smooth and steady ride. So I'm trying to think of one off the top of my head. So I don't know, we'll go with Google, right? If you take a look at their stock price history, I mean, that's a smooth and steady ride. I mean, obviously there was a massive sell-off right there in 2022 when people were suggesting that AI was going to make Google search obsolete, but come to find out, Google's thriving in the age of AI. I called it, by the way. At one point, I had 45% of my net worth tied up into Google as I made videos talking about why Google's going to thrive. And the division panned out. So people that are saying these software stocks like Salesforce are doomed, I'm like, bro, I feel like y'all are being dramatic here. But I guess time will see. But anyways, besides this little dip right here, it's a smooth, steady ride. Because with cyclical stocks, do you know what I'm saying? Depending on when you buy into them, if you buy into them when they're at their peak of the valley and they drop to their peak of the mountaintop, and then they drop to the valley, you're going to be upset because it's cyclical. Whereas with Google, when you buy into them at a good price with a margin of safety baked in, over time, it should theoretically go up. I don't know. I guess it really depends. Somebody might have listened to that and would have said, no, absolutely not. Dude, remember how we talked about poop earlier? Dude, I'm peri-dogging at this point. I got to drop a protein bar. It's one of those things where I contemplate, should I do it? Should I not before filming? And then I'm like, maybe I can hold it. And now I'm at that point where I'm peri-dogging. I'm like, gosh. But anyways, so here's a company that I really want to talk about. So Stride, I guarantee none of you know what they are, okay? Ticker symbol LRN. Now, after their last earnings report, I think they went on a sell-off of like 50, 60%. Let me zoom out and just show you this. They were trading for $153, and after they reported their earnings, sorry, I got too excited. I sounded like Fred Flintstone. They dropped to $66 a share. Are you kidding me? So let me back up. What did they do? Stride's in the business of supplementing, but also supporting the entire virtual school system for private and public school systems across the U.S. So if you want to take a class on calculus, history, they do the entire thing, the programming, the structure, the homework, the quizzes for the teachers so that you can do it. And you might be like, what? That's a stupid business model. And it's really not, because there's a teacher shortage across the US in almost every major market. And so they have to start turning to programs like Stride in order to keep the classrooms going. And even if there are enough teachers in a school system, sometimes students want to take a class on engineering or in marketing or in data analytics, but none of the teachers are qualified to teach it, right? Because you need certificates and educational background to testify whether or not you're qualified. So the Stride jumps in and they can offer that as a extracurricular or as a core academic class for the students. So when we talk about Duolingo, I don't think they're an educational tech company. Some people think they are. No, they're not. They're a gamified, doom scrolling language learning app that also ventured into chess and math and music. You already know I'm not bullish about Duolingo, but when it comes to educational tech, like Stride, dude, I'm absolutely bullish. So now that you understand what they do, let's talk about why they went on a sell-off. So they had a tech rollout issue that affected about 15,000 potential enrollments. Because their tech had some glitch or something like that, they weren't able to secure the contract for an entire school district or something like that. So they lost potential revenue of about 15,000 students. And they're also being sued for ghost students. And I did some research on this company, and it's something that they did in the past as well. They got sued and lost and paid out a crap ton of money. What do I mean by ghost students? It means they're charging the school districts, say like, for instance, 10,000 students in order to use the Stride platform and teaching modality. In reality, there's only 8,600 students. So what the heck? 1,400 are just made up names, or students that never enrolled, or students that signed up but quit, so they shouldn't be billed, but they get billed anyways. Me personally, I'm thinking about jumping in. But before jumping in, and you might be like, why don't you? Because year to date, they're up by 12.8%. That's financial engineering. They're doing a massive amount of share buybacks right now. I don't think anyone's buying into them. I think they're buying their own stock. I want to know, is the situation getting better? And if it is, then I'll jump in. But come to find out, if there's more scandals and more setbacks, I'm absolutely not going to jump in. Like, just taking a look at their top line, this is magnificent, this is beautiful. I would rather see a 17% revenue growth year over year that's sustainable rather than Duolingo's whatever, knowing that they could fall in the same fate as Skills, the mobile game app company, or Chegg. I truly don't believe in Duolingo's future, but with an educational tech company that partners with school districts, I'm bullish. Absolutely bullish. Now, if Duolingo branches off into teaching Spanish 101 for college classrooms or for high schools and everything, I promise you, my narrative will change. I'll be like, I'm warming up to the idea of Duolingo. I think I'm going to jump in. But a company that's already doing that is Stride, right? They already have the curriculum developed for almost every academic subject you can think about. English, mathematics, science, biology, chemistry, physics. I like this company. What I don't like is the recent scandals and setbacks. I don't want to jump in because, or until their earnings to figure out if it's temporary noise or if it's like a permanent situation. And because, like, think about it like this, right? If there's a company that's dealing with a lot of legal ramifications, if you jump in, you're going to have to be very patient as they trade sideways until it pans out, until the final court ruling goes against their favor or in their favor. Just like with Google, after their court ruling went in their favor, their stock price exploded. Same with 3M. After the court cases were all finally finished, they started exploding in valuation. So yeah. Golly. One of the good things about peridogging, though, it's helping me to stay alert. You know what I'm saying? Like, have you ever been on a road trip before and there's not another rest stop for like 60 miles? You just got to hold that bad boy in unless you want to pull over and drop a dookie in the middle of nowhere, New Mexico. That's a gamble. Because apparently New Mexico has one of the highest percentages of like drunk drivers, and somebody could just run you over as you're dropping a deuce. That's probably one of the worst ways to go, right? You're squatting over on the side of the highway, dropping some diarrhea because you had some sketchy-ass sushi at a gas station, and somebody runs you over 60 miles an hour. That sucks. I can't imagine. But anyways, that's something that rubs me wrong, by the way. You know, people who drink and drive, dude, that pisses me off so much. Because not only are you putting yourself in harm's way, like you have a family that depends on you, relationships that's going to be severed, people that are going to be grieving for you. But also, if your car smashes into somebody else going 120 miles per hour, that entire family's life is now permanently affected. Loss of life across the board. People who drink and drive piss me off. But anyways, where the heck were we, right? I think now we're into that weird territory of like the small mid caps. Oh yeah, we were at Stride. Okay, anyways, let's jump on over to Wednesday, 104 companies. Microsoft. Dude, I'm really nervous about Microsoft. I started doing some more research, and apparently there are sell-offs associated with OpenAI's profitability issues. Apparently, OpenAI is burning so much capital right now to battle it out with Google's Gemini and I guess all of the other LLMs. And Microsoft is a huge investor into OpenAI. But also, Microsoft, at the end of the day, it's a software company. Everything that they do, except the Azure cloud, is software-based. And all of the software players are also being punished harshly right now. But I'm thinking, dude, they're being so... When I mean they, I mean like big money hedge funds, Wall Street, those greedy people in New York City and Chicago. They're being unreasonable. The fact that across the board, no discrimination, every software company being sold off, to be honest with you, this could be one of the buying opportunities of the century, right? Or it could be like a physical newspaper company going into the era, or I guess the age of the internet. Maybe these software companies it's over. AI is going to take over all of our jobs. No one's going to have any money anymore. And we're all just going to be running the streets butt-ass naked. I don't know. But what I do know is that Microsoft's current business model prints cash. And one thing that I'm most bullish about, I mean, I talked about it in the past. People get really excited about Azure. People get really excited about Microsoft Suite, like their Office products, whatever. I get most excited about is their gaming division. If you have small children, then you know how influential Minecraft is. Well, guess who the parent company of Minecraft is? It's Microsoft. They're also the parent company of Xbox. They're also the parent company of Blizzard Gaming, so Diablo, Warcraft, StarCraft. I'm most bullish about gaming because even if AI takes over everything, we as humans, we still like to play video games and entertainment. Some of you watching this, you do it to stay informed of the markets. For others, it's for entertainment purposes, right? And I think video games and entertainment in general, I'm bullish about. We will always pay money to go watch a sporting event. We will always pay money to do this, live music. So I like Microsoft. I just don't like them in their current valuation because they're trading multiples of 33, forward trading multiples of 28. What I would like to see as a trading multiple in the current tense based on their trailing 12 months EPS, when I say that, I mean the bottom line per share of at least 24 or below. That way, there's a huge buffer from the average of the S&P 500. Their PE ratio is a 31 holistically. For Microsoft to be at a 24, 23, 22 PE, then I know that it's at a good price. So I'm going to be waiting patiently. I think I said at the beginning of the video, right? 400 or less, I'll probably start to dollar cost average. But Microsoft, again, I think they have the potential to go on a big sell-off, which for me translates to buying opportunity. I'm not telling anyone else to buy Microsoft or what to do with your money. Okay, I'm just explaining my thought process. That way you can kind of understand how another investor operates or their perspective. I would like to buy into them if they go on a sell-off. If they talk about their capex and the spending is going to slightly be higher than expected, you can quote me on this. They're going to go on a massive sell-off, and I'll jump in. I'll probably upload a video saying, hey guys, I bought Microsoft. So yeah, there's Meta, there's Tesla. Out of these three right here, I would feel most comfortable about Microsoft. Second would be Meta. I think Tesla, I understand, okay? Financially, it doesn't make sense, okay? I don't understand why their trading multiple is a 294 or 230 if you look at next year's EPS, their profitability of next year, when their top line is going down, 1.5% year over year. It's a company that's pretty much stagnant for the past 2.5 years, and you want to tell me that you want to give them a PE ratio of 300? Make it make sense. However, even though financially it doesn't make sense, I think people buy into it for Elon Musk and his promise of the future of what Tesla could be. And I did some research because I was like, dude, it doesn't make any sense and it's bothering me. Come to find out, EVs, that's what he's doing right now. The next product rollout is going to be an army of robots. And the intent and purpose is for them to replace all of the manual labor for everything. That's the vision. And I'm like, do I buy into that? I mean, I think as a society, we should say no, right? Because once you take away the entry-level jobs and then AI takes away the middle managers, then at that point, who the hell is going to be working? And how the hell do we make money? And how the heck do we buy anything, right? As a society, we should probably say no to that. But understanding Wall Street, understanding business, when you think about margins, when you think about overhead costs, when you think about SG&A, employee salaries, I feel like, dare I even say this, one of the first companies to adopt that principle will probably be the fast food industry to make the food. Second would probably be retail. And then I would argue the fulfillment centers of Amazon and Walmart. It's kind of scary. I think it boils down to the question of if everybody's job is going to be taken away by robots and AI, then how the heck will we survive or live? And maybe I should talk about that in a future video. So you might as well start investing into dividend stocks because if we're all going to be doomed, you might as well get paid from these corporations that doom everybody. I don't know. Maybe that's a little too doomsday thinking, right? We got ASML, Lam Research, semiconductor equipment manufacturers, AT&T. Okay, now we can talk about how I'm warming up to the idea of telecom. So previously, I didn't really like the telecom industry because it was a lot of capital expenditures in that they have to constantly replace their equipment to support the infrastructure of the cell towers, 3G, and then there's 4G, and then there's 5G, and then 6G is going to be rolled out. It's a never-ending cycle of having to upgrade the equipment, losing free cash flow to do so. And then I started thinking about it, and I was like, wait, that's really similar to utilities, though. And as a 35-year-old, dude, I love utility stocks because it's stable, it's a regulated monopoly, they have an economic moat, and it's something that we need till the end of time, right? You want to be able to poop and flush that poop? You're going to have to pay your water bill. You want to come home and put your hungry man frozen dinner into the microwave? You're going to have to pay your electric bill. And the reasoning goes on and on like that. Likewise, with the telecom companies, phone bills, one could argue, probably in the bottom half of necessities. I think the first would probably be the mortgage or your condo if you're newly divorced and you're paying rent. And then probably the utilities so you can live in that condo. But I think right after that should be food and then telecom. So I think telecom, I started to look at it in the same lens of utilities. It's something that everyone's going to have to pay for, the phone bills, because not necessarily because we all have landlines, right? Like if you have a landline still, you're probably over the age of 60. Almost every single human under the age of 60, you probably have a cell phone, and everybody wants to use their cell phone on a day-to-day basis, right? Then you're going to have to what? Pay your cell phone bills. And so I started thinking about it like that, but I think it really depends on the price entry, right? I don't think I would just jump into a telecom company willy-nilly. I would want to buy into it as they're in one of their cyclical lows, because there's highs and lows depending on their capex cycle. But AT&T is at the bottom of my list out of the telecom players. I'll tell you that right now. There's Progressive, which, speaking of which, I jumped in pretty big. I think it was last week. My memory's so fuzzy with a newborn. Dude, I went in pretty big because I remember when I did the insurance industry breakdown, there was like 3 or 4 that got the a grade evaluation of an S, which means superior, excellent. And I think it was Berkshire Hathaway. I think it was Travelers Insurance. And I think it was Progressive. And I think there's one more I just can't remember off the top of my head. I jumped into them as they reached their 1-year low at $199 a share. Obviously, I didn't catch the bottom perfectly. I was doing a technical analysis to figure out when. That's the thing. I'm a long-term investor and a value investor, meaning I like to buy stocks when they're on a discount, but I also apply the teaching principles of day traders. And that's why, as much as I like to make fun of them, I tease them every now and then on the channel, I'm not going to lie to you. The technical analysis indicators, it helps me so much with price entry. Because with value investing, I like to calculate how much a company's worth. That way I know, like, oh, is it a good deal or a bad deal to jump in right now? If they're fairly valued or undervalued. And then with day trading, I don't like to day trade. I do not day trade. I used to day trade in 2019. I do not day trade anymore, okay? With the day trading philosophy, I apply their principles into figuring out when to jump in, to catch the absolute bottom and the rebound. But yeah, I would argue it takes so much more skill and time to master day trading than it does to master the principles of value investing. Because with value investing, I don't think it takes a rocket scientist to understand a high quality business. Oh, Microsoft. Oh, Google. Oh, Apple. Buy into them. 10 years down the road, you'll be fine. But with day trading, I think it's a little more scientific or mathematical because you have to calculate everything perfectly. But I'm so glad I took the time to learn how to do it back in 2019 because I still use the learning lessons today, right? So I jumped in pretty big to Progressive. I don't regret it. I'm going to buy and hold this for a long time. And something lovely about them is their dividend profile. I mean, this says 6% dividend yield, but that's skewed and it's misleading. It's actually closer to like a 2.1, 2.2% because every year they pay a ridiculous special dividend out to the investors, kind of like Costco, except Costco's cadence is more like 3 to 4 years to get a special dividend. And then previous to Cracker Barrel becoming one of the worst restaurant stocks in the space, they used to pay out a special dividend every 3 years as well. But obviously Cracker Barrel is now a dividend cutter and they're really struggling. But with Progressive, they pay out a special dividend every year, and that's something I'm going to be anticipating. I don't know what happened in 2023, but that's something that I'm looking forward to. So this past year, they paid out a special dividend of $13.60. Are you freaking kidding me? Other than that, every other quarter, you're going to get 10 cents. But at the end of the year, you're going to get a juicy-ass dividend, and that's why I think Progressive is going to be a buy and hold forever for me. So pretty happy about that one. If you're a part of the Patreon, you tend to find out when I make these transactions on the spot. But their Starbucks, like I said, their economic mode is eroding and the beverage space the landscape is changing, dude. There's so many competitors where at this point, it's hard to say who's going to win. And besides, I feel like with the younger generation, Gen Z, Gen Alpha, Generation Beta, dude, how unfortunate is that for your entire group and cohort to be called beta? I don't know, maybe that's funny. But anyways, they're more likely to buy coffee from a local ma and pa shop, which I think is good, right? But I think it's the millennials that are really married to the idea of brands like McDonald's, Chipotle, Starbucks. Man, anybody under the age of like 28, they do not care about that. They'll just support whatever tastes good or whatever's trending. Because some Gen Z, they really like McDonald's, but others, they really like supporting ma and pa shops. So it really depends. Me personally, I really like the idea of entrepreneurs and small business owners. So I would rather people support the small ma and pa shops, but I say that as a McDonald's shareholder. So it is what it is, right? There's always a cognitive dissonance with me and my investments. I would rather be able to eat at a local ma and pa restaurant knowing full well that I'm invested into Domino's and McDonald's. I would rather United Health to cover the folks that are most vulnerable and that need that health insurance rather than cutting them out. Obviously, it doesn't make any sense, but I guess that's just who I am, right? My heart is a little different, but yeah. There's Elevance. Which, speaking of which, if you bought into any one of the health insurance players, the big ones, when they went on their massive little sell-off about a year and a half ago, I think like not even a year and a half ago, in July, I think you would have been a very happy camper. Obviously, with stock analysis, I can't pull up 6 months. On Google Finance, you can, but going from $274 to $371 and went up by $100, bro, you're probably a happy camper. Any one of the health insurance companies, you would have been a very good, logical bet. Me personally, I didn't bother going into Elevance because I was like, I'd rather just go into the biggest player, United Health. I also did go pretty big into Centene Corporation. They make their business model is predicated upon Medicaid and Medicare, but they're concentrated only in California. Now, I don't like California. I wouldn't want to live there. The high tax rate, the crazy drivers, the traffic, the high cost of living, the list goes on and on. But one thing that I understand about California is they're huge on public assistance, right? And so when I saw here, let me pull it up as I talk about it. CNC, I've got like, I want to say 8% of my net worth invested into them. And I bought into them right here, exactly right there at like $26 a share. Now it's $46. I'm in the green. I think it was like 85% last week I checked. Pretty happy guy. Centene, think about it, right? They do Medicaid, Medicare for California. California loves to do public assistance. So when I saw them going on that sell-off, I was like, okay, I'm jumping in. That's too easy. And obviously their forward trading multiple right here is a 19, but at the time that I bought into them, it was a 2 or a 2.5. It was a ridiculously stupid number. And that's why when I look at the software stocks sell-off, I don't blame you if you're going in big right now. I'm not going in big because I feel like there's more room to fall. But if you're going in big, it's the same logic that I had when I jumped in big to the health insurance stocks, right? So it's all about capitalizing on the small opportunities that only come, did I say small? I mean, the huge opportunities that only come once or twice a year. That's when you can make a killing. That's not financial advice. That's just me talking to myself because I'm delusional, and that's what I've been doing. Capitalizing when the markets become so fearful and they sell out an entire sector or industry to the point where it makes no sense. When I deploy my capital, that's when I have made my biggest gains. And now for some of you, you don't like the idea of timing the market, and bless your soul. I time the market like a mother because I've learned that patience rewards you hugely. Case in point, there's a company that was on my watch list for like 6-7 years. And it took me 6 to 7 years to finally pull the trigger and jump in because I was so patient as a pickle and waited for them to hit my price point based on their fundamentals and financials. And then once they recovered, bam, I was in the green by a significant amount. I'm trying to remember who that was. Sorry, I'm having a brain fart here. Who was that? I don't think it was, hold on. This is going to drive me up a wall if I don't figure this out. Give me 1 second. Let me see. Who was that? A company that was on my watch list for 6 to 7 years. And when they finally hit my price point, when they wanted to sell off, I bought into them, rebounded. I'm such a happy guy. Oh, it's United Health. What the heck am I doing here? Yeah, it was United Health. So, yeah. Like, could I have bought into them when they were $600 a share? Absolutely, I could have done that. Here, let me just pull up United Health as I talk about it. If you take a look at United Health, they were going up and to the right consistently and reliably, and then they hit $600 a share, and I could have bought into them thinking, oh, yeah, it's a high-quality company, and then bam, $356. Obviously, I would be very upset, right? Very upset. But I bought into them right here, July to August, when they went on that crazy sell-off. And now I'm a pretty happy dude. So, yeah, I absolutely time the market. But in the same way, I also don't time the market. I guess here's what I'm trying to say. I'm always investing. I'm always dollar cost averaging. But when it comes to individual stocks, I time the market. Hopefully that explains it better, the reasoning and the thought process. Why pull the trigger into Microsoft at $460 when I can buy into it at $399? Oh, but Amos, what if it never reaches $399? That's okay. I'm patient as a pickle. It took me 6.5 years to buy into United Health. Likewise, I have a watch list full of stocks where, depending on the day or the week, none of them are on sale. And then one day, boom, one becomes on sale. And that's when I revisit my investing thesis, and that's when I pull the trigger. And that's why I don't care who you are. If you're ugly, if you're rich, if you're a doctor, if your wife hates you, everybody ought to have a watch list full of stocks. That way you kind of have an understanding of who to buy when things go on sale or when the entire market's on sale. Or you can keep it simple, stupid, and just invest into VU, right? I mean, I said it time and time again on this channel, 99% of the people out here, you have no business investing into individual stocks. And I don't mean that in a condescending way or boastful manner, but I mean that if you invest into VU, you're going to get market returns, 10, 12, 14% year over year. When you choose to invest into individual stocks, you have to put the sweat equity in and research and stay up to date. It's a lot of work. I wouldn't want to wish that upon anyone. I do it because this is what I do 7 days a week, and I love it. The fact that I get to make YouTube content of what I do 7 days a week, dude, I'm so happy. And the fact that you're even listening to me talk about stocks right now, that's why I consider you guys my friends. My wife, she's sick of me talking about stocks. I can't talk to her about stocks. I can talk to you guys about stocks, right? I don't know. Fair Isaac, dude, I know there's a certain YouTuber who's so bullish on the credit reporting bureaus. I'm not. I truly think AI is going to flip that entire industry on its head. As in dissolve it. As in change the name of the game. So when I think about FICO, when I think about, who are the other one? Not TransUnion. Gosh, what's the other? Not S&P Global. I think because they have another business driver associated with the S&P index, I think they're safe. But I think their credit reporting business, that line, it's screwed. Who are the credit reporting bureau? Doing that on Google. My internet is acting up. Give it a second to load right here. Oh yeah, Equifax, Experian, TransUnion. Oh, I guess I was right with TransUnion. I think all those stocks are so screwed. And I tuned into this YouTuber the other day. He's bullish about it. And I'm like, dude, in the age of AI, if anything's going to be dissolved or obsolete, it's going to be the credit reporting bureaus. I feel like a lot of the companies are going to take that in-house or directly from AI instead of relying on these toll booth companies to get a credit report for someone that's trying to pull a car loan or mortgage. Just what I think, okay? Not all software companies are going to survive the age of AI. I think that's facts. Some of them are better positioned to thrive. I think Adobe is going to do great. But certain companies, I think they're screwed. And the market's punishing all of them across the board as if they're all screwed. And that's where I disagree, right? Anyways, I think I rambled a little too much right there. I'm so sorry, guys. Anyways, prior to filming this video, dude, I watched the Seahawks play the Rams. I'm not going to lie to you, I was sweating. I think the game could have gone either way. But at the end of it, after 4 quarters, dude, the Seahawks won the NFC Championship. Now we're going to the Super Bowl. Sign me up. I'm so excited. And I think I deserve that because, as you know, I also support the Tottenham Hotspurs. Dude, they're in a relegation battle. Again, we're one of the worst teams in the Premier League. And the fact that my American football team is thriving, dude, I'm so happy. Because can you imagine if both of my teams were struggling? Dude, that would suck. But I also do support another soccer team in the UK. They're based in Wales, and it's Wrexham. Obviously, as an American, I have no affiliation to Wrexham or England or whatever. But the reason why is because I watched the documentary called Welcome to Wrexham, and it kind of got me into soccer, and that's why I started supporting Wrexham. And they're crushing it. They might even make their way into the Premier League, right? So happy on that end, but I'm very disappointed with the Tottenham situation. VF Corporation, this one is a tricky one. I dismissed them a while ago. It's a parent company of North Face, Supreme, and what's that one wool company? Smart Wool, I think. And they're also the parent company of I can't say favorite. That's a lie. Because my favorite running shoes, I run a lot, by the way. New Balance, Saucony, Brooks. But if we want to be honest with one another shoe brand that people don't talk about enough is Ultras with an A. And it's basically a wide toe box, zero drop shoe. Really popular with the trail running scene, but Yeah, parent company is VF Corporation. The reason why I feel conflicted with them is it's a company where their financials are so trash, right? For the past 3 years, it's just in the red year over year. Not the kind of trend you want to see. And that's why I stay away from the fashion apparel industry, including Nike, including Under Armour, including Lululemon, because they go in trends. Meaning American Eagle and Abercrombie stocks are crushing it, and then the next year, they're going to be deep into the red. Likewise with VF Corporation, oh, we're crushing it, and now you're no longer the favorites of the peoples, right? When we talk about North Face, I like North Face, but I definitely think the quality went downhill over the years. When I was in high school, in 2005, 2006, 2007, dude, we all wore the North Face sweater, the zip up. I forgot what it's called, but it was like that furry texture to it. Now, I don't think anybody likes North Face to the same extent as we did like 20 years ago. But anyways, as a company that's in trouble, and the reason why I'm conflicted is even though everything about them is trash and their trading multiple is very expensive, an 83, 25 forward trading multiple, if you only look at it from April of $9.74 to what it is today, they're up 100% into the green. Now, obviously, right there it says negative 21. That's because stock analysis, you can't do the drag and scroll. But I can just tell you, it doesn't take a wizard. $9 to $19, oh, it more than doubled, right? So 100% into the green. And that's what it's like when it comes to these textile, I guess, apparel retail brands. Maybe buying them when they're at their absolute lows is the move, but how do you know when it's the low, right? Like maybe these guys thought it was the low in October 2022 when it was $28, and then it dipped even more. So it's like it's hard to just point your finger on investing into them, and I feel like with that, it's in the territory of gambling, because with like United Health, all the signs were there that they were a high quality company, right? Can I just pull them up real quick? By the way, welcome to my life, ADHD. This is what I do in real life too. I just bounce around different stuff all the time. But anyways, the evidence was there that it was high quality and thriving, right? So when they went on a massive sell-off, it was so easy for me to jump into them because the numbers line up in that they're high quality. But with VF Corporation, it's hard because their numbers are so bad that it's like if you buy into this for the inevitable rebound, quote unquote, inevitable rebound, this company could go belly up as well. With United Health, when people were speculating that they were going to go belly up, I was like, dude, you have no idea how massive and how important their network is to the foundation of healthcare in the US. If United Health falls, half of the hospitals in the US would have a blackout. I'm not exaggerating because the software is owned and is operated by United Health. Again, that goes into my investing thesis of too big to fail and is too important to the interests of the US to let fail. Boeing, Intel, United Health, Ford Motors, JP Morgan Chase. But yeah. Anyways, why did we go on that rant? Oh yeah, VF Corporation. Is this the parent company of Chili's, Brinker International? I think it is, right? Yeah, Chili's and Maggiano's, dude. Unpopular take right here. I think Olive Garden tastes phenomenal. No, I don't think it's authentic Italian, okay? I understand it's Americanized, but when we talk about the Italian restaurant chains here in the U.S., I say here like I live in, no, I don't live, I live in Japan, but I'm an American. Dude, Maggiano's head over shoulders better than Olive Garden. I'm telling you right now. Take your lady there on a date. You'll love it. The food is good. The portion's just right. The price is good. The environment is dark. I just love Maggiano's. But the thing is, Maggiano's is not what prints cash for them. It's actually Chili's. Look at that. 23% growth in their top line year over year for Brinker International. And a lot of that is attributed because of Chili's, because people are realizing, like, if you're going to eat out, you want to get your money's worth, right? And they're realizing, like, with McDonald's, again, I'm a shareholder, but I can talk trash about them, okay? Freedom of speech. Why pay $10 for a burger and fries when you can go to Chili's to get a huge serving of burger and fries for the exact same price, right? And that's what's happening. I think a lot of the consumers are gravitating towards Texas Roadhouse and Chili's to pay $10 to $15 to get a crazy amount of food instead. Which begs the question, Cracker Barrel, dude, they're struggle boating. They cut their dividend by 50% year over year. Look at their financials. They're struggling right now. And I think that's because their brand. Now, don't get me wrong. I think Cracker Barrel's food tastes phenomenal. Dude, go try their country fried steak and then come back and report to me on this channel. Tastes great. I think their mac and cheese, top 10. But their brand and image, right? Cracker Barrel, the old country western, like that doesn't resonate with the people. And that's why I understand why their marketing department pitched the idea to their C-suite of rebranding, changing their logo. Dude, it looks so bad. It looked like a drunk person tried to replicate Denny's. And I was like, dude, what the heck is that? And on social media, they were, like an 84-year-old that's like, I'm never going back to Cracker Barrel. How dare you? You know what I mean? And they folded. They're like, okay, we won't change the logo anymore. So I think with Cracker Barrel, instead of trying to change their identity, this is controversial, they should play into it. Hear me out. Instead of like the trying to rebrand themselves to be watered down and to be modern, I think they should play into the whole idea of like that southern, unhealthy, deep-fried, country-styled cooking that only your grandma can serve you at Thanksgiving. You know what I'm saying? They don't do that. They're trying to water themselves down to be like everybody else, and they're wondering with thumbs up their buttholes, why are we losing this game? Because you need to have a differentiator. You need an economic moat. You need a competitive advantage that sets you apart from your competitors. If you want to look and feel like your peers, then why would they ever go to you, right? They would just go to the other ones where they already know they can get a great experience because that's who they are known for. Cracker Barrel, you go to for that unhealthy, deep-fried country stuff. Like, Waffle House fits that bill, okay? But I would say Cracker Barrel's more of like that family family atmosphere for that unhealthy, delicious Southern-style cooking. If they were to play more into that, I'm calling it, they would thrive. But they don't want to. They're being stubborn. And I'm like, well, I guess they're just allowing themselves to fail then, right? Dude, we're only on Thursday. I mean, there's Apple, Visa. I sold out at Apple at $265. Do I regret it? No, because I bought into them in 2019, dollar cost averaged in 2020. And, after 5 years, to be in the green by like 85, or was it like 90%? I was like, it's time to walk away. Because with Apple, I think it's a slow and steady compounder, but I felt like my capital could have been better utilized in something else where it compounds at a better and a faster rate. But if you're investing into Apple, I don't blame you. I love them. I think their economic moat is fantastic. I'm most bullish about their Apple TV. Not so much about iPhones and MacBooks and everything else. I really like Apple TV. So I don't blame you. Sold out on them at $265. Do I plan on jumping back in? I mean, I'll be honest with you. Historically, they're kind of pricey right now. I mean it when I said it. When I think about the Mag 7, for me, I would rather buy into Amazon or Microsoft because historically, they're in that territory of kind of being undervalued. I'm not saying that's 100% fact, but to me, I think that's a truth because Amazon, their trading multiples usually like a 50, 60, and currently it's like a 30, maybe like a 29. And I'm not saying past performance is indicative of future gains, but I think with everything that they're doing, right, ZooX, with AWS, digital advertising, and everything else, I feel like the market's being way too bearish about the potential and future of Amazon. And then obviously with Microsoft, I kind of think they're fairly valued right now at 440, 460, whatever they are. But under 400, then we're talking, okay? Visa, I think they're fairly valued. I mean, I can share my homework with you guys on the Patreon. I really wanted to believe that they were undervalued, but they're not. They're really not. Past 1 year, you're in the green 0.8%. I feel like that's really sad for a dividend compounder with cheese. And that's why I was like, wait, are they undervalued? No, they're not. MasterCard, Caterpillar, Thermo Fisher Scientific. By the way, did you know this is the parent company of Nalgene? It's like a water bottle company that a lot of campers and hikers like to use because it's really lightweight when you're done using it. I feel like with an insulated steel cased water bottle, it's super heavy. Even when you finish drinking all of the water, it's still very heavy to ruck around, right? Talk about Lockheed Martin for a second, dude. This is a company that I bought. Oh, this is the other one. Do you remember how I was like, what's the company? 6-7 years I was waiting. This is the other one. Lockheed Martin. Dude, I was waiting so long to buy into this company. And then in July, I got my wish. And I bought into them. And I've been really happy since. Now, obviously on your screen, it says 18%. But mind you, I bought into them right here. I think my average cost basis was $417. I didn't cash the absolute bottom. But again, the day trading technical analysis, it helped me to predict and forecast 417. So I'm pretty happy with my cost basis. But 417 to 590, dude, I'm a happy camper. But at 590, I don't think I would dollar cost average or increase my weighting. Now, when they were at 417, absolutely no brainer. But at 600 a share, yeah, you know what I mean? There's Altria, which is a core holding of my dividend income portfolio. Not the highest quality, I'll admit to you. See, their top line's stagnant, or I guess even shrinking year over year, if I can pull them up. So the name of the game for them, because they're such a mature, established company, is optimizing their profitability. How can they run their operations in a more smooth manner while reducing overhead costs? And that's the name of the game right now. And as you take a look at their bottom line per share since 2021, I think they're executing it to a T. I mean, there's kind of a fall off right there, but that's what the market's evaluating them on. Not necessarily the growth in their top line, which is kind of weird because their sister company, Philip Morris International. Why am I spelling this wrong? Philip Morris International, by the way, fun fact, they used to be one company and they did a split off. They're actually growing and thriving. And that's because they have, what is that smokeless tobacco thing called that everybody in Sweden and Europe loves? I don't think Americans love it that much, but you Europeans, you seem to really love it. I think it's called like Zyn. Yeah, so that's propelling their growth. Whereas with Altria, they do have a similar product, but it doesn't have as much buy-in from the consumers. And then obviously they have their old usual tobacco products. So it's one of those companies where I understand that it's not high quality, but it has a very big, here, take a look at their dividend profile to speak volumes as a testimony. A 6.8% dividend yield, payout ratio means it's 79% sustainable, growth rate higher than the rate of inflation at a historical rate, 57 years of growing their dividend. So I bought into them for the dividend income, not necessarily for the capital appreciation, but they've been doing both. So been pretty happy with that one. But again, I will say it's not a dividend compounder with cheese. Then what do we got? We got SanDisk also pumping right now because of the whole SSD movement, because data centers and AI LLMs need large amounts of RAM in order to be optimal. Yeah, for 1 year performance to be 1,200% into the green, if you invest into SanDisk, I'm happy for you. I truly am. To be honest with you, I didn't think of investing into SSDs. I didn't think of it. I should have. And I think that's why I'm recently on the channel, we roasted a portfolio that went balls deep into the physical infrastructure supporting the AI movement. And he kind of got me thinking, instead of investing into the software players utilizing the AI, I think the physical equipment and the accessories, not a bad idea. And that's why I got the wheels turning in my head, and that's why I'm trying to buy into this HVAC company known as Carrier Global. Just can't get it to the price that I want. He keeps bouncing back up. But yeah, there's NASDAQ. Dude, I only have like 1 or 2 shares of this, and I bought into them after I made a dedicated deep dive video on the channel. And I said that they were undervalued, and then sure enough, they were undervalued. I think I bought into them like right here. I think they were like $45 a share when I bought into them. I know it doesn't show it here on the screen because it doesn't show the intraday trading price, only the end of day price. But I'm a pretty happy guy. I'm well over 100% in the green with NASDAQ. Obviously, when you think about the QQQ or the NASDAQ 100, yes, NASDAQ is that company. They get a royalty check and a kickback for the people that buy into their ETFs and to be included in their little inclusive category of stocks. I think it's primarily tech companies in the NASDAQ 100. Everybody except the financials, based on my memory. I could be wrong. Tractor Supply Company. Dude, when people buy into Home Depot or Lowe's, I'm like, why? The superior home improvement store is Tractor Supply Co. Now, obviously, that's a consumer's take, right? I don't know about their financials. It's not bad at all either. And the stuff that they sell is really, they cater towards actual farmers. And when you're a farmer, you can't really buy a barrel drum or water. Is it called a trough? The thing that horses drink out of? Like, you have to go to a physical store to buy big equipment like that. I don't know. I'm pretty bullish on Tractor Supply Co. I like it. Anybody else on a Thursday? There's Oshkosh Corporation. I love this company, right? I sold out of them at 145. I should have held on. I didn't know that they were going to go up to 153. But also another one of the companies that I bought into after I made the dedicated deep dive video. I saw that they were super undervalued. I feel like at the time that I made that video, I mean, right now they're trading multiples of 15 and 13. When I made that video, it was around like this period right here. I think their trading multiple was like a 4 or 5. And I was like, I'm going in. I don't care what anyone else says. Based on what they're doing, they're so high quality. And when you think about the landscape of the U.S. military and the motor pool of every United States Marine or Army transportation unit, you look left and right, most likely an Oshkosh vehicle. And the defense budget, it's only getting bigger and bigger. The investing thesis was simple, and the investing thesis came true. And I just kind of wish I held on with that one. But whatever. And that's why I'm holding on to my other military stocks, like Huntington Ingalls, Lockheed Martin, and I think there's one more. Maybe not. There's Althea Harris. Love this one. That's also a military company, by the way, if I didn't finish my sentence there. Anybody crazy here I want to call out? Robert Half. Dude, I have to drop a dookie, and my stomach is growling. I'm getting hungry. Anyone else hungry? Let's see. Friday. ExxonMobil and Chevron, the two biggest oil and gas conglomerates. I went back and forth on whether or not I wanted to include them in my biggest winners of 2026. Go watch that video, by the way. I just uploaded it a few days ago. In the end, I decided not to go with them because I feel like it's too, what do you call? I mean, how do I say this? It's like, it's almost too easy in that I don't think they're going to be an outperformer. I think everyone has their eyes towards oil and gas with the current administration, how much they're promoting drilling, and obviously with the Venezuela situation. Having said that, it's so mainstream that I feel like it's not going to be an outperformer. Does that make sense? Based on my calculation, I think Chevron and Exxon, I think they're going to get inline returns with the S&P 500. So if it's 15%, it's going to be 15%. Having said that, I'm like, this video is supposed to be the best performing stocks of 2026, right? And that's why ultimately I did not include them. I like an American Express. I think I said that before. I think out of the big three, MasterCard, Visa, and American Express, I mean, there used to be Discover as well, but they got swallowed up by Capital One Finance, headquartered in, I want to say Nova, or is it Richmond, Virginia? Either way, in Virginia, I really like American Express. But as you can see, just like Visa and MasterCard, they're also in a pickle right now. Well, actually, not so. They're actually crushing it. The reason being is that the current administration, they went on record by saying they're going to cap the credit card interest rate. I think it was 10%. Don't quote me on that. I think it was 10%. And because of that, they went on a pretty little sell-off. I don't even know if that's a sell-off, a 2% correction. They went on a small little dip because of that. I guess a 5% dip. I really like American Express, but I don't like them at their current valuation. And I think the reason why I like them ahead of MasterCard and Visa is that American Express caters towards a lifestyle of affluent and rich and the wealthy income folks. Meaning, American Express is the parent company of the Platinum Card, which gives you access to the American Express Lounge. And that category and demographic of people, they tend to be more resilient in economic downturns, right? People that are making or clearing six figures for your household income, you're gonna be, well, statistically, okay? Statistically, they tend to be okay when things hit the fan, unless they're one of the affected ones because of whatever went south. So keeping that in mind, I like the margins of American Express. I like that they're catering towards the affluent crowd. Because when you have a business operation, the first question you want to answer is, what are we selling? And then the second question is, and who is our target demographic? Who is our customer base? If you're just spraying and praying, dude, you got to go back to the business board, or I'm sorry, drawing board. That's one of the first things that I learned in my MBA education. You have to have it down to a T on who you are and who are you trying to sell your stuff to. And I feel like that's what Cracker Barrel's struggling with. They don't even have an identity anymore. And that's why they're spraying and praying and they're losing their core customer base, which were the boomers, people that are like 65, 75, 85. They're not exactly going back to Cracker Barrel. And so they're like, okay, then maybe we should go towards Gen Z. And Gen Z doesn't even want to go back to them. So they're losing money, right? I think if they would have ramped up their marketing tactics to bring back the elderly, or I guess the senior folks, that would have been a better bet for them. But I think they're thinking long term and saying, well, those people, they're getting up there in age. They probably won't eat out as much. Are you stupid? If you go into any IHOP, Denny's, or breakfast chain, from 9 a.m. to 11 a.m., the entire place is crowded with senior citizens. They absolutely eat out. But anyways, I think Cracker Barrel's thought process is, why aim for the older generation when we can aim for the younger generation and turn them into lifetime customers? I get the thought process, but I feel like they made too drastic of a jump. Meaning, I think they should have zeroed in on the senior citizens and then made their way slowly down, right? After the senior citizens, target families with children, and then target young married couples, and then go from there. But they made the huge jump from senior citizens to trying to cater towards Gen Z that are super health conscious, and it's like, Cracker Barrel, get it together. You don't make healthy food. You don't. And you're trying to cater towards an audience that doesn't like your food. You know what I'm saying? It's like somebody up there in the building, they're just not, I don't know. The fact that like 20 people in a board meeting, they all shook their heads and were high-fiving each other on their plan, boggles my mind. Boggles my mind. How the heck did not one person speak up and say, hold on, is this really the best step forward for a company? I don't know. It goes to show you, right? Like, I know I'm an idiot, but it goes to show you that I'm still serviceable to a corporation. Like, if I were to stop YouTube cold turkey, which I don't want to, I think I could still pivot into a strategy position in a business. I mean, that's what I was previously doing prior to making YouTube content full time. I was part of the strategy team of one of the biggest pharmaceutical companies in the world. Do I miss it? Sometimes I miss it. I miss the paycheck, obviously. But I also love what I'm doing right now, right, with YouTube. And I think that's the biggest blow. Like, pursuing my dream, I don't have a big paycheck anymore, right? But I don't know. I'm continuing to believe in myself, and I'm thinking one day the money will follow. As of right now, it sucks, and a lot of sacrifices have to be made, but it's something that I'm willing to do. They're Centene. We literally just talked about them. So they're reporting on Friday as well. Anybody else? Under Armour. Gosh, listen, when it comes to Under Armour or Nike gear, I really like Under Armour, okay? But when it comes to the stocks, I don't like either one of them. I know that's a little harsh, but all right, friends and family, that just about wraps up the companies that are reporting their earnings this week. I appreciate you hanging out with me. I actually had a pretty good time. Like literally, we're kicking back right now, talking about stocks. For how long have we been doing this? For an hour and a half. It was a good time. If you had a good time, let me know. Having said that, stay safe, good luck in the stock market, and love you!